What's up guys, Megan here with Bearable Traders. I'm here today to be your Duolingo for trading. If you're a newer trader, I'm sure you felt that at times you are learning a completely new language. Well, it is. The terminology in trading isn't typically something that is learned or practiced on a regular basis. You don't just say, hey, the bid looks heavy on the L2 to your friends and family every day. If you did, they'd probably just stare at you in complete and utter confusion. So if you're new to trading and trying to understand what on earth everyone is talking about, I've got you covered. There are a lot of terms to know, so we'll just start with a handful in this video, not to overwhelm you, and let's get into it. Bull or bullish. If a trader or investor believes a stock is strong or will go up, they are a bull or bullish. This could be for longer holds during the day, the week, month, but it can also be for momentary short bursts in time. Bear or bearish. Alternatively, if a trader believes a stock is weak or will go down, they are a bear or bearish. During all of the well-known market crashes to date, you will hear traders and investors mention the downtrend as a bear market, otherwise known as a place where the stock price or market enters a decline. Going long. When you are long a stock, you are buying in hopes of the price continuing to rise. So you buy at 10 bucks and you plan to ride it to 11, 12, 50, 100, a billion. This type of trading is a bit more well known, and it's what many people are doing with their longer term investments. Going short. The flip side to going long is going short. When you are short a stock, you are borrowing shares from your broker to sell in hopes of later buying them back at a lower price and making a profit. Opposite of going long, going short means you are betting on the stock price going down. If you've ever watched the movie The Big Short, this is basically the premise of the entire thing. And if you haven't watched it, now you have weekend plans. Level 2, or what we like to call it, the L2 for short, is better known as the order book. This is where traders can see all of the orders, well, most of the orders, that are waiting to be filled and at what price buyers and sellers are eagerly awaiting their turn to get in or out of a position. When you hear people talk about the price action, the level 2 or L2 is part of it. We're watching what's happening with the price on here. What does the action look like? The ask, also known as the offer, and the bid. There are two sides on the level 2. The right side, better known as the ask or offer price, indicates where the sellers are sitting, where traders and investors are asking or offering to sell the stock at in hopes that the buyers will make their way to that price. The left side, known as the bid, indicates where the buyers are, where buyers are bidding for a stock. Take eBay for example. People go to eBay to bid on an antique or some crazy item that you haven't seen in centuries. This would be the left side of the L2. On the other side, the ask side, you have a seller ready to sell at the best possible or highest price people are willing to pay. Pattern Day Trader Rule, or PDT. This rule is one of much heartache for newer traders using brokers in the US. This rule states that if you take 4 or more trades in any 5-day trading period, as in you buy and sell a stock the same day, you are considered a day trader. Awesome, you're a day trader now. But what comes with this title? Unfortunately, this now means that you will need to keep a minimum balance of $25,000 in your account at all times, or you can no longer day trade. You can still invest long-term and swing trade, but day trading will be off the table. So if you don't have $25,000 and are interested in day trading or taking more than 4 trades per 5-day period, you will need to look into brokers who are not located in the US. Float. Float is the amount of shares that a company has available in the open market for investors and day traders like us to buy and sell. This isn't technically all of the shares that a company has. We refer to that as outstanding shares. This, however, is the amount we get to play with after insiders and employees have taken their shares. You may be familiar with the term low float stock, which is just a way of describing a stock with a smaller amount of shares available for trading. Short float. The short float of a stock is the percentage of shares that traders and investors are shorting in relation to the total float or available shares. For example, simple math. If a stock has 100 shares available on the open market, or a 100 float, and 50 of those shares are being shorted, then the stock has a 50% short float, which, by the way, is really high. Market orders and limit orders. A market order in the most simple terms imaginable is an order you place that says, get me in right now, or get me out right now. You place it and you enter or exit the trade immediately at whatever price the current ask is, or in other words, whatever price the current sellers are sitting at. On the flip side, a limit order is an order that you place at a specific price and say, I'll wait, you can come to me. I like limit orders, I use them all the time, but I also like to play hard to get. All right, you guys, that's a handful of trading terminology to get you started. Remember, this is a new language you're learning, so be patient with yourself as you begin to absorb all of this. I'll be back again with more terms to fill your trading dictionary. If you enjoyed this video, please like and subscribe. Until next time, thanks so much for watching.